Hello and welcome. In this lecture video, we're going to do an additional problem used on the indirect method. And then we'll do one other quick check problem as well. And then the next lecture video will cover the investing activities section. Okay, so this lecture video is just doing a practice problem, all right? So I'm going to move forward in your course pack. I'm going to go to this page right over here. Based on the following income statement, the balance sheet for Rashid Corporation, determine cash flows using the indirect method, okay? So here is the indirect method. Okay? Well, this is where we're going to do the indirect method. And so to do the indirect method, we need to have the current period's income statement, which we have that. We also have to have prior periods and current periods balance sheets. So those are the prerequisites to do the indirect method. You have to have our current period income statement and then prior period balance sheet and current period balance sheet, okay? So I'm going to go ahead and jump into it and start off with the indirect method. The first thing that we always do is we get net income right there. Find net income, which we find it on our income statement. And so I'll write down net income, which is our $11,300. Okay? And then the first step, after we do that, we look at changes to non-cash current assets and then to current liabilities. Look at the changes in the account balances for non-cash current assets and current liabilities. So you can see with this problem, I don't have anywhere where I say total current assets. So you need to know, first of all, what's a non-cash current asset, what isn't. So accounts receivable, that is a non-cash current asset. Inventory, that is also a non-cash current asset. In equipment is plant, property, and equipment. That is not a current asset. That is not a current asset. So then we can look at our liabilities. Accounts payable, that is current liability, and income taxes payable, that is also a current liability. So with step one for the indirect method, we're going to be looking at changes in accounts receivable, inventory, accounts payable, and then step two, we look at accounts payable and then income taxes payable. Step one, non-cash current assets. Step two, current liabilities. Okay? So you look at the changes in the account balances and we basically apply the rule. So you can see with accounts receivable, I'll start there. It was 29. It is now 21. It decreased by $8,000. So I can say plus, and I'll just put a plus right there, my decrease in accounts receivable. And that is given to us, we calculated that at $8,000. Because remember the rule, a decrease in current assets in non-cash current assets is added to net income. An increase would be subtracted. So now the next current asset we can look at is inventory. Was 52.1, now it's 58. It increased, which means I'm going to subtract those two. Gives me 5,900 when I calculate 58,000 minus 52.1, $5,900. And because it increased, I will subtract that. So I'll put a little subtraction right over here. Subtract increase in inventory, which is given to me $5,900. Those are my only two non-cash current assets. I don't have any prepaid expenses. I don't have any supplies. So I can't make it up. This company just doesn't have it. So if it's just not listed, just assume they don't have it. Now we can go on to step two and look at our current liabilities. And our current liabilities for this company are accounts payable and income tax payable. They don't have any interest. So they don't have any interest expense, and they don't even have any interest payables. Okay, so they just have these two. And you can see with accounts payable, it increased, and then with income taxes, it decreased. And so our rule, when we have an increase in the balance of a current liability, that will be added. The decrease in the balance of a current liability, which would be this situation, will be subtracted. And those are the rules that we talked about in that prior lecture video. So I'll say plus increase in accounts payable, AP, which when you subtract it, $4,700. The way I got that was the 28,400 minus the 23,700. And then what I have is my income taxes payable. I'll say minus decrease in income tax payable, which is $150. Put that in parentheses showing its negative number where I'm going to subtract it. That's step 1. Step 2. Step 3, remember, is to add depreciation. Where do I find depreciation? On the income statement. And here's my depreciation expense, $42,000. Now, keep in mind that the real step 3 is to add back non-cash expenses. But for the context of this class, I'm telling you the one that we're going to focus on is depreciation expense, which is given to me at $42,000. That's step 3. Step 4 for the indirect method is to subtract out any non-operating gains and add back any non-operating losses. We find that right here, other gains and losses, there are no losses, but we do have this gain of $7,200, and we subtract that out. Say minus gain on sale of equipment, which is given to me at $7,200. And then I'm just going to write down, I'm just going to put this total down here. It's not the official format, but I just want to show you the total adjustments for learning purposes. So I'll say my $8,000 minus my $5,900 plus the $4,700 minus the $150 plus $42,000 minus $7,200 gives me total adjustments $41,750. Then what I can do is say net cash provided operating activities $11,300 plus my adjustments gives me my $52,750. And that is my net cash provided. If these adjustments were negative, if this were, $80,000, for example, this would make the total adjustments negative, right? And then we would subtract that from net income, and that could push us into a negative situation here where the cash outflows exceed the cash inflows. In that case, we would not say net cash provided. We would say net cash used. Okay? All right, so that's that example, and that's on page 60 and 61 right over here. Okay? So what I want to do now is I want to look at this quick check problem right over here. And we're going to do this one later. So I'll hold off on that one, okay? We'll do this one later. But why don't you go ahead and pause the lecture video and do this quick check problem. Okay, hello and welcome back. So as I said, this one deals with investing activities, so we'll do this one in the next lecture video. This one is the one I wanted you to do right now. Pretty easy. The indirect method for the preparation of the operating activities section of the statement of cash flows. The right answer is C, reports net income and then adjusts net income for items necessary to determine net cash provided or used. Okay, so that's the right answer, and that's the only one of the answers that actually says we report net income and then adjust it. So that is the right answer. Okay. Let me go back to the prior page right over here. And I just want to make some comments that we can have some differences between net income and our net cash flow from operating activities. Why can we have differences? So for example, with right over here, we had net income of $11,300, but net cash provided by operating activities of $52,750. What are those differences? Well, we have some timing differences, right? So for example, we can record a sale, whether or not we got cash right away. And so, but that is also different than when we receive the cash. So statement of cash flows cares about when did you get the cash. Income statement says, well, when did you make the sale? And those can be two different points in time, two different accounting periods. So there are timing differences. Okay, so the first one is timing differences. That's why we have some discrepancies between net cash provided and then net income. The other one is, look at this with depreciation. Non-cash expenses, right? They pull down net income, but what we do is because they're a non-cash expense, we add it back to net income to show us how much cash we actually got from operating activities. So when you look over here, non-cash expenses, timing differences, also non-operating gains and losses. Why do we subtract out the non-operating gain? Because we want cash flow from operating activities. And by definition, this is non-operating. So we want it out. And that's why we would add back a non-operating loss. In the context of this problem, they did not have a non-operating loss, so there's none to add back, but if they did, we would add it back. Okay. So to summarize why there are differences, we have non-cash expenses, timing differences. Again, you can recognize revenue even when you haven't received the cash for the revenue. Non-operating gains and losses. And so these are the three reasons why we have those differences between net income and net cash flow from operating activities. Okay? All right, I'm going to end this lecture video now. The next one is going to talk about investing activities. Thanks.